Robschild, nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, millionaires don't need astrologers, but billionaires do, so we begin. Markets are down today. And why are they down? Like I mentioned yesterday, the markets were kind of waiting to see what would happen with this consumer price index. These differences of numbers don't seem like they're very big, but they are fairly significant. This middle number, so scroll up here. Median, this is previous, so what it was last month. This is medium forecast is the middle number, and the actual forecast is this left number. So previous month consumer price index 0.3% month over month. The actual was, the predicted was 0.2%, so we were predicting to go lower, but instead it stayed the same. Uh-oh. And then for core CPI, we actually expected it to be flat, and it actually went up. Another uh-oh. And then CPI year over year, we expected it to drop from 3.4 to 2.9. It still did drop from 3.4 to 3.1, but at a slower rate. And then the core CPI went from previous month of 3.9% and stayed flat at 3.9% instead of dropping to 3.7%. That's pretty much the whole story of what happened in markets today, and we'll go through some of the finer data points. Fairly large move down in the S&P 500. The major headline that's going out is the biggest drop in the Dow since almost a year ago, back as far as March. So that's sort of a headline. I think that's a little more fear-mongering than necessary. In the S&P 500, if you look at this trend line here, we actually touched it and got right back over it, and so from this perspective, it almost looks like a buy the dip kind of a scenario. High yield corporate seems to, again, whenever I see the stock market going crazy, I take a look at what smart money is doing. What are the people that are invested in bonds doing? Are they worried about bankruptcies? And if they are, then this fund will start to collapse. But this fund, it hardly dropped at all today, 0.5%. As you can see, it's like it didn't even notice the report came out today. Additionally, one other point to not blow this too much out of the water is that the volume today, although higher than usual, it's not higher than some of these other fairly random days. On a true big market sell-off, you might expect this volume to be much higher, but we'll see what happens tomorrow as a reaction to what's going on in markets today. If we move on to the VIX, the fear index, this was a fairly sizable large candle. The VIX showed a lot more fear throughout the day. If you look at what happened during the day, we spiked towards the end of the day and sold back off. That's why you see that sort of topping tail there on this candle here. As an investor myself, I decided that I'm gonna get a little bit of insurance by getting some exposure through options contracts through a leveraged version of the VIX, the UVXY, because I am concerned. I see, if inflation really, I had been, from previous reports, believing that inflation was going down more and faster than most people had thought. And if you had listened to my previous shows, I have been of the opinion that we would see evidence of inflation going down and down at a faster and faster rate, and this is bringing that narrative into question for myself. And so I'm getting a little bit of insurance now for potential higher volatility. And of course, when you see a candle like this on the VIX, this can easily turn into turning into something of a much greater proportion. Again, my reasoning, especially looking at high yield corporate, tells me, I probably overdid it by getting a little insurance today, now that I'm at home actually looking through these charts a little bit. But that number, those CPI reports do make me feel more nervous and make me think, well, crystal ball wise, I'm probably not the only one feeling this way. But enough about me. Let's finish the main charts. Here we have the TYX 30-year bond yield, one of my favorite things to follow. If we see this as a head and shoulders pattern here, we finally broke through this, and I had said before, seeing this as a pole and a candle, my expectations was around for us to get to around, I think, 4.5, and then this head and shoulders, if this really does play out, we should expect it to go as high as 4.7, 4.8. Again, a candle like this can easily completely reverse tomorrow, but I'm actually hoping with my crystal ball that we get up to this range so that I can lock in some more bond exposure at this current time. At the end of the day, when inflation is high, what does that mean? It means a tighter Fed. It means more fear in markets. And what does that mean? It means markets can go down. It means rates can stay higher. It means that, it's funny, the cure for inflation is inflation in a way, because it kind of will beat itself up eventually. I'm starting to put into question, the whole fiscal dominance narrative that's been going around, saying that all of the fiscal spending is sloshing around the economy, which is going to keep inflation perhaps going higher, hotter for longer by itself. I don't know what to make of that anymore, especially after this report. Again, my crystal ball is the colors are starting to shift around a bit. This here is the Treasury yield curve going from 1 month all the way to 30 years. The red line was yesterday's yield curve, and the blue line is today's curve. And so you can see the entire curve really went up. So this CPI, it's making the Treasury market believe in higher inflation for longer, for sure. This market is supposedly some of the smartest money out there, and it's showing more nervousness about the CPI. But again, HYT is my favorite indicator as far as trying to see what's going to be happening for the immediate future in the stock market, and it doesn't seem to be concerned. And so the insurance that I had gotten may have been not the right move at this time. But anyway, so CME watch tool, well, the last most interesting point here is we had 6 rate cuts on the table looking into the future up through March 2025. Now we have 1, 2, 3, 4 cuts. Only 4, from 6 to 4. That's pretty big, The Fed all along has been telling us outright they were expecting 3 cuts. The market had been pricing in 6 up until basically today. Well, it was 6, and then it was 5, and now today it's 4. So don't fight the Fed. I guess that's all there is to it. I don't know if I have anything. I think I have anything else to offer the internet today. I hope you enjoyed the show. Thank you for watching. Robschild.